Most business owners are overpaying the IRS, not because they want to, but because they've never been told about one incredibly powerful tax strategy. It's called the Augusta Rule. This rule allows you to take thousands of dollars out of your business every single year, and the best part, you don't have to pay a single penny of tax on it. Now, I know what you might be thinking. Henok, that sounds too good to be true. There's no way the IRS would allow that. But that's exactly what I want to show you in today's video. By the end of this breakdown, you'll know what the Augusta Rule is, where it came from, who qualifies how to use it properly, the mistakes that get people in trouble, and some real-life examples so you can see the numbers for yourself. Stick around because this could be the cleanest $10,000 or more you'll ever make in your business. So let's rewind a bit. The Augusta Rule has a funny origin story that starts in Augusta, Georgia. Every spring, Augusta hosts the Master Golf Tournament. If you know golf, you know it's one of the biggest events in the world. And what happens when thousands of fans, players, and media descend on a relatively small city? Hotels sell out. People start scrambling for places to stay. Local homeowners realize they could rent out their homes for a week or two and make massive money. We're talking tens of thousands of dollars in rent, sometimes for just a few days. Now, normally, the IRS would tax that rental income, but lawmakers thought, hey, this is a temporary, short-term situation. These homeowners aren't really in the rental business, so they carved out a special rule. If you rent out your personal residence for 14 days or less in a year, then the income you make is completely tax-free. Think about that. Any other type of rental income like Airbnb, a beach house, or a basement apartment, you'd have to report it and you'd pay tax on it. But if you keep it under 14 days, you don't have to report it at all. It's invisible to the IRS. And that's the rule business owners discovered they could apply strategically. So how do business owners use this rule? Let me give you the play-by-play. Step 1, you have a business entity. That could be LLC, S-Corp, or C-Corp. The point is, your business has its own tax identity. Step 2, your business needs a place to host events. We're talking board meetings, annual strategy sessions, client dinners, workshops, instead of renting a hotel or a conference space. You host it in your home. Step 3, you determine fair market rent. This is very crucial. You look up what hotels or event spaces in your area would charge for a similar setup. Let's say the Hilton charged $1,200 for a day-long meeting room. If your home has comparable space, you can justify charging your business around that amount. Step 4, you document the event. That means you create an agenda, you take meeting minutes, and you keep an attendance sheet. Step 5, you invoice your business. Yes, literally send an invoice from yourself as the homeowner to your business as the renter. Step 6, your business pays the invoice. The business records it as a deductible expense. You deposit the money personally. And here's the magic. You don't report that income on your personal tax return. As long as you don't go over 14 days in the year, it's tax-free. If you follow these 6 steps, you've just moved thousands of dollars from your business into your personal account legally and tax-free. So let's put some real numbers to this. I had a client in Washington, D.C. area who runs an S-Corp. Every quarter, he held board meetings at his home. Each meeting was a full day, and he charged his company $3,000 per meeting. Now, why $3,000? Because we pulled comparable rates for hotel conference spaces in the city, and that was right in line. So 4 meetings a year at $3,000 equals $12,000. The company deducted the $12,000. He personally received it tax-free. The $12,000 was even enough to fund his Roth IRA contributions for the year and still have money left over for family travel. That's $12,000 in his pocket that the IRS cannot touch. Now, before you run out and start writing checks to yourself, let's cover the mistakes that get people in trouble. Mistake number 1, exceeding the 14-day limit. The second you hit day 15, all of it becomes taxable. Not just the 15th day, the entire amount. Mistake number 2, overcharging. You can't just say, my house is worth $10,000 a day. You need fair comps. If hotels near you rent for $1,000, stick close to that range. Mistake number 3, no documentation. If you get audited and you don't have agendas, minutes, invoices, and proof of payment, the IRS will throw it out. Mistake number 4, using it for personal events. Hosting your kid's birthday party does not qualify as a company event. Remember this, if a hotel would provide an invoice, a contract, and a receipt, you should too. That's what makes this bulletproof. I had another client who owned 2 businesses. For one business, he did everything right. Invoices, agendas, proof of payment. The deduction was allowed without any issue. But for the second business, he got sloppy. No paperwork, no minutes, nothing. During an audit, the IRS disallowed it completely. It's kind of like having 4 tires on your car. If 3 are flat, you're not going anywhere. The paperwork is the air in the tire for this strategy. Without it, the whole thing collapses. Now let's tackle some myth I hear all the time. Myth number 1. This is some kind of loophole. No. This is literally written into the tax code. It's as legitimate as deducting office supplies. Myth number 2. You can rent to anyone tax-free. Wrong. If you rent to someone else's business or a stranger, that income is taxable. The tax-free benefit only applies when your business rents it from you. Myth number 3. I can do this without a business entity. Generally, no. Sole props don't get the same clean separation that LLC and S-Corp provides. Myth number 4. I can charge whatever I want. Not true. It has to be tied to fair market value or you risk disallowance. So please, don't let myth keep you from using this and don't let misinformation cause you to misuse it. Let's imagine you run a small consulting firm. You hold 2-day quarterly strategy retreats at your home. You research local rates and a hotel conference room costs $1,200 per day. You charge your company $1,200 per day for 2 days, 4 times a year. That's 8 days total, well under the 14. 1,200 times 8 equals $9,600. Your business deducts the $9,600. You personally receive $9,600 tax-free. Now let's say you also host 2 client appreciation dinners at your home during the year at $1,000 each. That adds another $2,000. That's a total of $11,600 still under the 14 days. That's $11,600 tax-free money just for hosting legitimate business events at your home. So let's recap. The Augusta Rule lets you rent your home to your business for up to 14 days. The business deducts the expense. You receive the income tax-free. The key is fair market rent and documentation. Common questions. More than 14 days, it's taxable. Rent to someone else, it's taxable. Need an entity? Yes. Can you stack this with other strategies? Absolutely. It fits beautifully into an S-Corp tax planning playbook. So here's the bottom line. The Augusta Rule is one of the cleanest ways to legally put money in your pocket tax-free. If you do it right, under 14 days, fair market value, proper paperwork, you can save thousands every year. If you want me to review your setup or give you the exact templates for agendas and invoices that make this bulletproof, book a call with my firm using the link in the description. Don't wait until tax season. This is something you plan and execute during the year. And if you found this helpful, hit the like button, share it with another business owner who needs to hear it, and subscribe for more strategies that save you real money.